Hey there, future billionaires and financially curious folks. Ever wonder if those massive, industrial companies churning out everything from airplane parts to smart thermostats are secretly printing money for their investors? Well, today, we're diving deep into one such behemoth, Honeywell International, ticker symbol HON. Get ready, because we're about to peel back the layers of this industrial giant and see if it's a sweet investment or just a sticky situation. Hello everyone. Welcome to EPK Capital's deep dive video. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Honeywell. So, who exactly is Honeywell? Imagine a company that's been around since 1906, starting with thermostats and slowly but surely, like a well-oiled machine, expanding into aerospace, building technologies, performance materials, and safety solutions. They're practically everywhere, from the cockpit of a Boeing 787 to the smart sensors in your office building. Now, who's at the helm? While Honeywell doesn't have a single promoter group, in the traditional sense, like a founding family that still holds a majority stake, it's a publicly traded company run by a professional management team and overseen by a diverse board of directors. As of October 2025, Vimal Kapur is the CEO, steering this massive ship. It's a testament to its long history that it's evolved from a niche thermostat company into a diversified global technology and manufacturing powerhouse. Alright, let's get down to the numbers, because numbers, my friends, don't lie, unless you're a comedian using them for a punchline, which I might do. We're looking at a decade of performance, roughly from 2015 to 2025. Revenue growth. Honeywell has shown consistent, if not spectacular, revenue growth. We're talking an average annual growth rate in the mid-single digits. For instance, in fiscal year 2024, they reported revenues of approximately $36.7 billion, up from around $35.8 billion in 2023. This isn't explosive growth, but for a company of this size, it's a steady climb, like a well-maintained escalator. Profit growth. This is where it gets interesting. While revenue can fluctuate with economic cycles, Honeywell has been pretty good at translating that into profit. Net income has generally seen an upward trend, with some fluctuations due to divestitures and acquisitions. For example, their adjusted earnings per share, EPS, have consistently grown, showing management's focus on operational efficiency. In 2024, adjusted EPS was around $10.70, a healthy increase from previous years. Debt levels. A quick glance at their balance sheet usually shows a manageable debt-to-equity ratio. Honeywell typically maintains an investment-grade credit rating, meaning they're not swimming in excessive debt. As of late 2024, early 2025, their long-term debt was manageable compared to their cash flow, giving them flexibility for future investments or acquisitions. They're not exactly living paycheck to paycheck. Profitability, margins. Honeywell boasts strong operating margins, typically in the high teens to low 20s. This indicates efficient cost management and strong pricing power. Their aerospace and performance materials segments, in particular, often contribute to these robust margins. It means they're not just selling a lot, they're keeping a good chunk of change from each sale. Now, let's gaze into the crystal ball of the stock chart. No, not that kind of crystal ball, the digital kind that shows past performance and makes us all pretend we can predict the future. Long-term trend. Looking at a 10-year chart for HON, you'll see a pretty consistent upward trajectory. It's like watching a well-behaved rocket gradually ascend. There have been dips, especially during broader market corrections like late 2018 or early 2020. Remember that little global hiccup? But it's always recovered strongly. Support and resistance. Historically, HON has found strong support around the $180-$200 mark during significant pullbacks. On the resistance side, it has broken through previous all-time highs, most recently pushing past the $220-$230 zone to trade in the mid-$200s as of October 2025. These are like invisible force fields the stock tends to bounce off. RSI, Relative Strength Index. The RSI is a momentum indicator. When HON's RSI gets above 70, it's often considered overbought, meaning it might be due for a breather. Below 30, it's typically seen as oversold. Over the past year, the RSI has generally oscillated within a healthy range, indicating no extreme overbought or oversold conditions, suggesting a more balanced momentum. But remember, technical analysis is like reading tea leaves, fascinating, but not always a guarantee. Time for a dose of wisdom from the father of value investing, Benjamin Graham. We're going to apply his famous formula, or at least the spirit of it, to see if Honeywell is currently a bargain, a fair deal, or a bit of a splurge. Graham's original formula, V equals EPS asterisk, 8.5 plus 2G, needs some tweaking for today's market, but the core idea is to find a company with stable earnings and growth potential. Earnings per share, EPS, as of October 2025, let's assume a trailing 12-month, TTM, EPS of around $10.70. Growth rate, G, Honeywell's historical and projected growth rate has been modest but consistent. Let's use a conservative 5-6% for long-term growth. Price to earnings, P/E ratio. This is crucial. Honeywell's P/E ratio has historically traded at a premium compared to the broader market, often in the low to mid-20s. As of October 2025, if the stock is trading around $200-$220, its P/E would be in the low 20s. So, if we plug in those numbers and compare them to the current stock price, based on a typical Graham-style valuation with a reasonable growth rate, Honeywell often appears to be fairly valued to slightly overvalued at its current levels. It's not a screaming bargain in the classic Graham sense, but for a high-quality, stable company, you sometimes pay a premium. It's like buying a brand new, reliable car. You pay for the quality and peace of mind. It's rarely on the discount rack. Every investment has its good side and its, maybe not, side. Let's weigh the bull and bear cases for Honeywell. Pros, bull case. Diversification and stability. Honeywell's diverse portfolio across multiple industries, aerospace, automation, materials, makes it resilient to downturns in any single sector. This is a huge plus. Strong margins and cash flow. The company's ability to maintain high profit margins and generate significant free cash flow allows for reinvestment, dividends, and share buybacks. Innovation and technology. Honeywell is constantly innovating, especially in areas like industrial automation, sustainable technologies, and smart building solutions, positioning them for future growth. Global presence. A vast global footprint provides exposure to growth in various economies. Cons, bear case, cyclical exposure. Despite diversification, some segments like aerospace are cyclical and can be impacted by economic slowdowns or geopolitical events. Valuation. As discussed, the stock often trades at a premium P/E, meaning future growth is already priced in, limiting immediate upside for value investors. Competition. Honeywell operates in highly competitive industries, requiring continuous innovation and efficient operations to maintain market share. Supply chain headwinds. Like many industrial companies, they can be susceptible to global supply chain disruptions and raw material cost fluctuations. No company is perfect, and it's important to look under the hood for any bumps in the road. Scandals or controversies. While Honeywell has had its share of regulatory challenges and environmental compliance issues in its long history, there haven't been any major, recent, headline-grabbing scandals that fundamentally threaten its business model as of October 2025. They've generally addressed these issues and moved forward. Global market position. Honeywell is a dominant player in many of its segments. In aerospace, they're a key supplier to major aircraft manufacturers. In building technologies, they're a leader in automation and energy management. And in performance materials, they hold strong positions in critical industrial chemicals and advanced materials. They're not just participating, they're often leading. Alright, folks, we've taken a whirlwind tour of Honeywell International. What have we learned? We're looking at a well-established, diversified industrial giant with a strong history of consistent revenue and profit growth. While its stock often trades at a premium, reflecting its quality and stability, it's a company deeply embedded in critical global industries. Honeywell isn't likely to be a get-rich-quick stock, but for those seeking a stable, quality company with long-term potential and a strong dividend history, yes, they pay dividends, often growing them, it certainly warrants a closer look. Ultimately, whether HON is right for your portfolio depends on your individual investment goals and risk tolerance. Do your own research, consult a financial advisor, and remember, the stock market can be as unpredictable as my attempts at stand-up comedy. Thanks for tuning in. If you enjoyed this analysis, hit that like button, subscribe, and let me know in the comments which stock you want me to dissect next. Disclaimer: this video is for informational and entertainment purposes only and should not be considered financial advice. Please consult with a qualified financial professional before making any investment decisions. Investing in the stock market involves risks, including the potential loss of principal.